So our next speaker is CA Prateek Bothra from MMJS Consulting. He's Senior Manager with the Tax and Regulatory Practice. His vast experience includes leading multiple assignments, providing end-to-end support to a credible portfolio of clients, specializing in advising on business setup, structuring, application of double tax treaties, withholding tax matters, VAT, corporate tax implementation, tax compliance, audit support, and tax litigation. Prateek has delivered VAT implementation projects in UAE, Saudi Arabia, and across various industry sectors. He assists wide range of clients in review of zakat, CIT, VAT, WHT returns, tax audits, leading health checks, and litigation for tax matters before the tax adjudication committees and courts. He also advises diversified portfolio of clients on tax optimization models, financial modeling, and business restructuring advices. Prior to joining MMJS, Prateek was working with KPMG India and assisted clients in the implementation of GST and transitioning from excise tax, states VAT, and service tax. Let's welcome CA Prateek Bothra with a hand of applause.
Good morning, everyone. Thank you, Suma, for the brief introduction, and John and Umesh for setting up the stage. So today, what we will be discussing about is the key concepts for UAE federal corporate tax. Now, as Umesh rightly said, that we already have received a brief guidance from the Ministry of Finance and the FTA on how the UAE corporate tax is going to be. We have received a very good guidance in the public consultation. We have received a broad guidance under the public consultation document and the FAQs and other information released by the authority. Now, what we need to do is we need to understand certain key concepts which will be introduced under the proposed federal corporate tax regime in the UAE. Now, today I would be covering about the guiding principles for UAE federal corporate tax and certain key concepts which are relevant for all the businesses which are in the UAE, or even if they are based out of a foreign jurisdictions and they don't have a legal entity in the UAE, how the UAE corporate tax could impact you. So currently in the public domain, the basis source of information about the UAE federal corporate tax is three sources of information. First is the flyer and the FAQs which were published or released by the Ministry of Finance in January this year, where they announced the corporate tax regime in the UAE and what would be the key features of the corporate tax regime in the UAE. The most important source of information is the public consultation document which was released by the Ministry of Finance and the FTA on 28th April 2022, wherein they invited comments from various businesses, consultants, and other stakeholders in the UAE on what comments they have on the public consultation document, which broadly outlines major principles which will be brought under the proposed corporate tax regime. Now, I'm sure like many of us would have spent our Eid holidays reading this public consultation document, decoding it, how it would impact our business, how it would impact our clients and industry as a whole in the UAE. Apart from that, the public consultation document also specifies what is the rationale and the key principles why a federal UAE corporate tax level tax is being introduced in the UAE. Now, one of the rationale for introducing corporate tax in the UAE is that UAE wants to borrow from the best practices globally and internationally accepted principles. They don't want to start with a clean slate and draft the laws, everything from scratch. They want to borrow from the best international practices to increase transparency, to increase efficiency in administration and the monitoring of the tax laws. So that businesses know these concepts where companies are working in multiple jurisdictions across the world. They should be familiar with key concepts, the main issues which are there. So we would be covering these key concepts which are there across the globe, and OECD, as we know, is one of the biggest governing body of international tax law and how the corporate tax regime should work, how the taxes should be treated between two different countries. So UAE has borrowed certain provisions for the OECD model tax conventions and transfer pricing regulations, what they have clarified in the public consultation document as well. So first we will see some key principles for UAE corporate tax. Now UAE Corporate Tax Guidance Key Concept Section 3 talks about the taxable persons. Who would be the persons who have to pay the corporate tax? Do we need to pay corporate tax as individuals? The companies need to pay the taxes, or the foreign companies which are having contracts with UAE companies have to pay the taxes? So under the taxable persons, they have clarified that any company which is incorporated in the UAE, what it means is if you have an LLC or even if you have a free zone company in the UAE, you would be considered as a taxable person. So basically what people were thinking earlier, that free zones would be outside the scope of corporate tax regime. That is not the case. Free zones are very well within the scope of UAE corporate tax. The only thing is they can benefit from the 0% corporate tax instead of paying tax at the standard rates if they fulfill the underlying conditions and the requirements. Now along with the foreign entities, along with the UAE resident companies or incorporated companies, there is another critical area where they have clarified that the foreign entities who have a permanent establishment in the UAE would be subject to corporate tax in the UAE. So what permanent establishment means? How to determine if a foreign company has a permanent establishment in the UAE or not? If I just have a contract, if I am a company based out of India, I am having a contract for export of goods from India to a company in UAE, would I be triggered to have a permanent establishment? Do I need to pay taxes in India or UAE? This is a very critical question. So permanent establishments we have covered in detail in the next slides, where we discuss about what are the different kinds of permanent establishment, how to determine or ascertain if you have a permanent establishment in the UAE or not. Another key principle is the place of effective control and management. So what they have said is, okay, even if you don't have a legal entity in the UAE, you don't even have a trade license in the UAE, you are a foreign company registered, incorporated outside the UAE, these foreign companies could also be subject to tax in the UAE if their control, effective control and management lies in the UAE. So what it means is, if I am sitting in UAE and I am managing and controlling the operations of an Indian company, that Indian company's income could be subject to tax in the UAE. So this is again a very critical provision which talks about the effective control and management, which again we have covered in greater detail in the next slides, and we have even covered a case law which is the landmark judgment in the field of effective control and management, which we will discuss in the later slides. Now free zone persons, they have said that okay, you can benefit from the 0% corporate tax exemption. You have an option where you can pay 0% corporate tax if you fulfill certain conditions. But if you have any income which is sourced from the UAE mainland, so if you are a free zone company, you are just doing exports, okay, let's say a 90% income comes from export of goods outside the UAE, but 10% of your revenue is sourced from the UAE mainland. If you are, let's say, providing some business support service to your group companies in the mainland, or if you are providing any technical assistance to your customers in the mainland. So if your income is sourced from UAE mainland, the free zone companies would be subject to corporate tax at standard rates instead of the 0% exemption. So that's why it becomes very imperative for all of us to understand what is the meaning of term source of income. How to determine if my income, if for a company, if my income is derived from the UAE mainland or from the free zone or from outside the UAE. So we will be covering these concepts in greater detail in the next slides. Now we have seen that okay, there are some taxable persons, which includes natural person earning business income, which includes UAE incorporated companies, which could include companies having a permanent establishment in the UAE, or even foreign companies who do not have any presence in UAE, but they have their effective management and control in the UAE. Now we will see what is the basis of taxation. What would be the basis of taxing these taxable persons? Now residency is one of the key determinant whether you will be subject to tax in a particular country or not. So we all, like most of us, would be the UAE residents. So would our income be subject to tax or not? How to determine the residence of a company? Because for individuals we have Emirates ID, we have visas to determine if you are a resident or not. But how we determine the residency of a company? Or could there be conflicts in the residency that, okay, we could be a resident of India as well as UAE because we have an Indian passport, we may be traveling to India or some other country very frequently for work purposes. How these would work? So, the public consultation document clarifies firstly that any legal person that is incorporated in the UAE will be considered automatically a tax resident of UAE. Thereafter, it also clarifies that any natural person who is undertaking an economic activity or a commercial activity in the UAE would be considered as a tax resident. Thereafter, a foreign entity, now this is a deeming fiction where they have elaborated that a foreign company with no presence in the UAE, no legal entity in the UAE, would also be considered as if they are a resident in UAE for tax purposes if the effective management and control of that foreign company lies in the UAE. And now when you say, okay, we are a resident, let's say we agree that, okay, this company is a resident of UAE because it's incorporated in the UAE, what will be the implications? Why is it important? So, they have clarified in the PCD that all the residents companies, all the resident companies would be subject to corporate tax in UAE on your worldwide income. Now, it is not similar to VAT where we say, okay, export the goods, not the taxes, that you zero rate the export of goods, export the services. Here they have said that your worldwide income would be subject to corporate tax in the UAE. For instance, if you are in the business, you are a business in mainland, you are 100% engaged in export of goods from UAE to an overseas country. For VAT purposes, you may be just paying 0% VAT and maybe in a refund situation. But for a corporate tax purposes, since you are incorporated in the UAE, a resident of UAE, all your worldwide taxable income would be subject to tax in the UAE. For non-residents, it's not the case. They are not subject to tax on their worldwide tax global income. Non-residents will be subject to UAE corporate tax on the taxable income which is attributable to a permanent establishment if these companies have a permanent establishment in the UAE, or if they are deriving any income which is sourced from UAE. So, if you are a foreign company supplying some services to UAE where the source of income is the UAE, then you would be subject to UAE corporate tax. It could be under the withholding taxes where currently the proposed rate is 0%, but still there is a tax. There is an enabling provision, today it's 0%, tomorrow it could be a higher rate of, let's say, a 5% or a 10%. So, basically it is not a tax free income, it is subject to tax currently at the rate of 0%. Now, next we discuss in detail about what is the concept of tax residency. We know that if we are a resident, we need to pay the taxes. Okay, we all agree that we are residents, we have to pay the taxes. We are using the infrastructure of the company to generate business income. Now, how do we determine where this concept of tax residency is coming, or why is it important? Now, the residency concept is important for primarily three scenarios. First is to determine the scope of application of domestic laws. So, first, if you are a resident of a country for a particular year, you may have to pay personal income taxes or other taxes in that country. So, it is important to determine your residency. Second scenario talks about the double taxation. There are multiple scenarios where you could have a dual residency due to a conflict in provisions or different provisions in the countries. For instance, Indian income tax law says that if you have been in India for 60 days or more in a particular year, and if you have been in the country for more than 365 days in the last 4 years, you could be considered as a tax resident of India. At the same time, you have a UAE visa, you have a Emirates ID, you are staying in the UAE for more than 182 days, then you are a tax resident of UAE as well. Now, where do you pay the taxes? Should you pay the taxes in UAE, where there is no personal income tax? You would always want to say, okay, I am a resident of UAE, I do not have to pay taxes on my salary income. But can Indian government challenge you that, okay, no, hold on, you have been in India for more than 60 days or you have fulfilled these criteria, you are an Indian resident as well and we want to tax you. So, in these cases where there could be a potential double taxation or double taxing rights allocated, the concept of residency comes into place, and then the model tax convention or the double tax treaty signed between the two countries comes into play, which has a tiebreaker rule which talks about that which country you are a resident of and which country will get the taxing rights over your income. Next is that in cases where there is a double taxation due to a source based taxation in one country and a residence based taxation, then again it's very critical to determine the residency, the country where you are a resident of. Now for companies, normally tax residency is if you are incorporated, there is a test of incorporation. If you are incorporated, you are considered a resident. If you have a fixed place of business, you may have a permanent establishment. For individuals, generally there is a concept of number of days calculation, where if you have been in a country, staying in a country for more than 182 days, you could be considered as a tax resident. Now if you are a tax resident, the domestic laws will govern how your income would be subject to tax for that particular year or for that particular entity. Now what's very important to note is that we discussed when we spoke about the basis of taxation or the taxable persons, that permanent establishments are subject to tax in the country. In the UAE, if you have a P, you will be subject to tax. But having a permanent establishment in a country does not mean that you are a resident of the country. So what it means is, if you have a permanent establishment in the UAE, you are a taxable person, you have to pay taxes on your income which is attributable to this PE, but you are not considered as a resident. Now again, the question is why it's important to be considered a resident. I'm anyways going to pay the taxes, it's okay, the government is getting its due share. For companies, why it's important is that if you are not a resident of a particular country, you cannot benefit from the double tax treaties. Now UAE has a vast network of double tax treaties with more than 100 countries across the globe. So if you have a permanent establishment, you are paying the taxes on the income attributable to this country, and you may be paying taxes in a foreign jurisdiction as well, maybe in the form of a withholding taxes or some other form of taxes. But since you are not a resident, you cannot benefit from the relief which is provided under double tax agreements which UAE has with more than 100 countries. So that's why it's very important to understand if you are a resident or if you are just a PE. Now PE, if you have a permanent establishment in the UAE, your income could be subject to tax on a net income basis, which basically means like you will have your income, you will have certain deductible expenses, that net income could be subject to tax in the UAE, and there is an authorized OECD approach. So Article 5 of the Model Tax Convention elaborates what is a permanent establishment, how do we determine if you have a permanent establishment in a country or not. But the allocation of taxing rights or the allocation of income is discussed in Article 7 of the Model Tax Convention, which talks about an authorized OECD approach, which is like a 2-3 hour long discussion in itself, which we have not covered today, but we would be happy to cover in a later session. Then now we will see in detail what is an effective control and management. Okay, we know that if your company, if your foreign entity is effectively controlled and managed from UAE, you would be subject to taxes in the UAE. You would be considered a tax resident of the UAE. Now, how do we determine these? Is there any guidance available, or is there any reference available? Because UAE had said in the PCD that they will rely on international practices, the best practices internationally. So is international law talking about it, or is OECD discussing about it? Now the good thing is, yes, there have been a lot of discussions, debates about the place of effective management. It is a concept which has been there in place for more than 100 years now. If you will see the mature tax jurisdictions such as India or the UK or the US. Now UAE corporate tax regime talks about effective control and management, which is similar to the concept of place of effective management. I'm sure many of us would have heard or seen the word POEM rule somewhere, which basically means place of effective management. Now there has been a landmark judgment in the case of DBS Consolidated Mines versus Howe back in early 1900s in the UK, where the House of Lords discussed about the concept of place of effective management for the purpose of tax residency. Why was it important? Because the UK could have gained, or actually they gained, a tax revenue of more than $3 million GBP back in 1900s. So it was a very big substantial amount which they gained by this concept. So we have covered the facts of the case and the decision in the next slide. Currently what we want to inform you is that it's a very fact based thing, like I can say, okay, the effective control of a company is in a foreign jurisdiction because the board of directors are meeting there, we are having the ROC filings there, we are having all the required compliance done there, the control and management of that company is there. But there could be cases that, okay, there could be the management and control is happening in India of a company. At the same time, there are some key decisions taken in the UAE as well, because the ownership or the shareholders, promoters of that company are in UAE now. Now, there could be different place of management of a business. There could be different places around the world where a business is controlled, especially if we see in today's globalized world where there are multinational enterprises headquartered in different countries, having their subsidiaries, related companies in different countries. Now, what is important is there could be different places of management, but the law says there could only be one place of effective control and management. Now, how do we determine these? It's a very fact based approach. It will determine on each case to case basis how the facts are there, how the documents are prepared, where the key decisions are taken. However, OECD guidance provides for certain factors to be considered while determining if you have a place of effective control and management in which country. Now, first is place or situs of critical decision making. There could be two countries where the decisions are being taken, but there will be only one country where the key decisions are taken. Now, again, it's subjective. What are the key decisions? Is discussing about mergers and acquisitions, financing a key decision, or discussing about operations is a key decision. How do I operate the company? How do I work? How do I generate the revenue? How do we produce the goods, manufacture the goods? Office of the CEO and the key managerial persons. So, normally all the decisions, major decisions of the businesses are taken at the board level, the directors level, where the CEOs and key managerial person of a company are there. So, while determining a place of effective control and management, we see where the offices of CEO and key managerial person are there, which country are they resident of, where they take these decisions, what is the situs here. Then the next is where the company has their headquarters, where the main decisions are being taken, and where the records are kept, like there could be accounting records, there could be legal records, ROC filing. So, that is why we need to see all these factors, and these are again inclusive factors. There are more factors than these which needs to be considered. Different countries have their own rules for determining place of effective control and management, and these can vary from a country to another country. If you are determined to have a place of effective control and management in UAE for a foreign entity, then you would be subject to corporate tax on worldwide income. So, what companies could do right now, what all of us could do is, maybe if we are working in the organizations, we are working for our clients, we can start these discussions. We can try to determine that, okay, there is a holding company in BVI or in Cayman Islands or Marshall Islands, but everything is done here. You are maintaining the records here, the key people are here, the decisions are here. It's just a holding company which is consolidating, which may be getting some royalty for the IP it holds. So, it's very critical to determine if the control and management is in UAE or not. If it is in UAE, how you can as a business plan in advance, because otherwise this income would be subject to tax in the UAE. There could be cases where you can get the tax credits of the taxes paid by that foreign company in their home jurisdiction. But if you have a company, let's say a country like Bahrain, where there is no corporate tax as of now, you could be paying an additional tax of 9% or more on your income, which is earned by the Bahrain entity just because the control and effective management is within the UAE. Now, we have given a pictorial representation of the DBS consolidated mines versus How case. So, here what happened is DBS as a company had two offices, two locations. One was in South Africa, where they were having diamond mines. So, DBS is the company which made diamonds famous used for all these purposes. Earlier diamonds were used mainly in industrial processes because of the hard rock quality. So DBS, what it was doing is it had its mines in South Africa where they were mining, extracting the diamonds, and then they were polishing and whatever. They also had an entity in UK. So there were directors in both the countries, in the UK as well as South Africa. There were board meetings which were regularly held in South Africa as well as UK. And what DBS was saying is that our taxes or our income should be taxed in South Africa, because our operations are there, our legal entity is there, that is where we are signing the contracts, or that is where we are doing the mining, that's where majority of the operations is done. Now this was challenged by the UK tax officer, who said that no, your control and management of this company is in UK, because you are taking the key management decisions in the UK. Decisions such as acquiring new mines in South Africa were being taken in the UK. They had majority of directors who were tax resident of UK, who were taking the decisions in UK. How to finance these new acquisitions, how to finance the operations were taken in the UK. So basically the tax officer said that no, hold on, your key decisions are taken in the UAE, in the UK. So your effective control and management is in the UK. Your situs, your source of income is UK, and it should be subject to tax in the UK. And they basically issued a tax bill of more than £3 million in 1900s. Now the company argued that no, we have meetings, okay, we have meetings in UK. At the same time, we have meetings in the South Africa as well. We are documenting, we have minutes of the meeting which were produced as an evidence in the case. Now what the House of Lords ruled at that point of time is, and at that point of time there were no specific rules for effective control and management. It is after this landmark judgment that the countries actually started developing the rules for effective management and control in their jurisdictions, and these rules are still evolving 100 years down the line as well. So interestingly, what Supreme Court said in this, what the House of Lords said in this case is that they said that okay, you have the operations in both the countries, the frequency of meetings is the same in both the countries, the directors are meeting, decisions are being taken. But what is important is what kind of decisions are taken in South Africa and what decisions are taken in the UK. So they delineated that in South Africa you are deciding the operations process only, that you know how the mines are working, how to improve the efficiency of the manpower, of the labor, how to extract more diamonds out of it. But in UK was the place where you were actually fixing the prices with the diamond syndicate, that okay, what price do you want to sell the goods. You were signing the contracts in UK, the financing arrangement, these main decisions of merger, acquisitions were taken in the UK. So your effective, though you had two places of management and control, South Africa for operations purposes and UK for key purposes, your effective management and control of the South African entity lies in the UK. And that's why we will consider this DBS South Africa as a tax resident of UK, and you have to pay taxes on this income in the UK. So this is the landmark judgment which made the concept, which introduced the world to the concept of place of effective control and management, which has grown significantly over the last 100 years. Now these are some other case laws. So place of effective control and management has lot of international jurisprudence, especially in Western countries and mature tax jurisdictions such as India. So these are some of the key jurisprudence. So one of the cases is wherein the company was having their operations in two countries. So what they said is that what is important is where the real business decisions are being taken at. It's not important that okay, for the ROC filing purposes or other regulatory filing purposes, you are taking a decision in a certain country, you are stamping on the decision, you are signing on the contract in a certain country. What's important is where in reality, in substance, basically it talks about substance over form, in substance where the actual decisions, where the real decisions were taken and who has the power to take these decisions. Another interesting case is the Layer State BV case, wherein there was a promoter of a company and there was a board of director who were resident in different countries. Company was treating itself as a tax resident in the company it was incorporated, where the director was resident, because that's where they were doing all the filings, they were signing all the important contracts, signing all the board resolutions. But when the court or when the authority got into the facts of the case, they realized that the director is just for the regulatory purposes, that because for a company you need a certain number of directors, you need an authorized signatory in the country, you need a front face. So the director was just a rubber stamp, but the actual decisions were taken about how to conduct the business, how to increase the business, the growth, the financing, everything was taken by the promoter who was in a different country. So the court held that the place of effective management and control of this entity is not in the place where the company is incorporated and the director is resident, but actually where the decisions are taken, which was the country of residence of the promoter. So these are very important concepts, and as we discussed, it's based on the facts of the case. Each case could be different. There could be board meetings at two different places. The important thing is the key decisions, where it's more effective control and management lies of a particular foreign company. Now we see about the permanent establishment. So we discussed about permanent establishment in the basis of taxation in the taxable persons, that permanent establishments are subject to corporate tax in the UAE. Now how do we determine a permanent establishment? What kind of permanent establishments are there across the globe? UAE public consultation talks about a fixed place PE and a dependent agent PE, wherein they say if a foreign company has a fixed place of business available to it in the UAE, it would be considered as a fixed place PE. Or if they have a dependent agent in the UAE who is habitually signing the contracts, negotiating or concluding contracts on their behalf, it would constitute a dependent agent PE of the foreign entity, and this entity needs to take the tax registrations in the UAE, need to comply with all the regulatory requirements such as filing of the tax return, payment of the taxes and other things, allocate its income to the permanent establishment, pay the due taxes. Now permanent establishment concept, if we talk about OECD, it is introduced in Article 5 of the Model Tax Convention, which defines what is the meaning of a permanent establishment, what is a PE. Now Article 5(1) talks about that a fixed place of business which is available to a company where their substantial or part business decisions, where the business of an enterprise is partly or wholly carried on, is a fixed place of business and it constitutes a permanent establishment. Taking this further, Article 5(2) of the permanent establishment clause talks about what are the specific inclusions in a permanent establishment, which includes a foreign branch. So if you have a foreign branch, so when we see the trade license of different businesses, some of you may have a branch of a foreign company in the UAE through which you are doing the businesses, because you set up an entity in the free zone, you have 100% ownership of the foreign company. So there are a lot of foreign branches in the UAE to have 100% ownership by a foreign company. Now these foreign branches are not tax resident of UAE, they cannot be formed part of the tax group as well, because the tax grouping provision talks that only UAE resident group of companies can elect to form a tax group. So if you have 10 companies, okay, let's say you have 8 companies which are incorporated in the UAE, resident of UAE, and you have 2 branches of foreign companies, you cannot group all these entities together because the branches are not considered as tax resident. Then apart from the branches, any place of management which is available to a business is considered as a fixed place P. An office, a factory and workshop, a mine, oil and gas well, all these are considered as a fixed place permanent establishment of a foreign company, which even the UAE public consultation document talks about. Now to determine if you have a permanent establishment or not, again there are various factors which needs to be considered, various tests, which includes if you have a place of business for you in the foreign country. Okay, if you have a place of business, is it available for use to you or not? Then the permanence, if you are just traveling for a day or 1 week, it's not a permanent place which is available to you. So these are some of the factors which are considered while determining the permanent establishment, if you have a P or if you don't have a P. Now there is again lot of international jurisprudence in the case of P, where the different countries, the different courts, different officers have decided if a foreign company has a P in the home country or not. We have covered one of the famous case laws from India, where in Supreme Court ruled that Formula 1 World Championship Limited has a permanent establishment in the UAE because they had a fixed place of business available to them in the UAE. This case law we will cover in the next slides. Moving on, we have seen the fixed place of business PE, which includes any branch, factory, office, oil well or other place available to you. Now Article 5.3 talks about a construction PE, which is again mentioned in the UAE public consultation document. So what is a construction PE? Basically, there could be a foreign company coming into the UAE to underdo a construction. Now we know UAE is always constructing some of the world's best marvels, be it a Burj Khalifa, be it a Museum of the Future, or be it the Warner Brothers Park or other places in the UAE. Now if a foreign company is coming in the UAE to do the construction work, they are not incorporating in the UAE, they are just coming to advise, they are setting up the places. Now if the construction contract lasts for more than 12 months, as per the OECD constitutes a PE, but the UAE public consultation document says that the UAE will trigger or consider a foreign entity to have a PE if they are signing a contract for construction which lasts for more than 6 months. And now there are certain general anti-avoidance or GAR rules, as we call them, wherein if you try to split your contract, if you had a contract for 9 months, you want to split the contract for like 5 months and 4 months so that you don't trigger a PE. So there are certain general anti-avoidance rules which are contained in OECD and which we expect to be contained in the UAE, where if you want to abuse the laws or if you want to take undue advantage of the laws, these clauses restrict you to take these undue advantages. Then Article 5.4 talks about certain exclusions. We have seen that now there could be genuine instances where a foreign company has a place of business available to it in the UAE, but it's not generating any income. If it's not going to generate any income, there would be no tax income or no revenues for the tax authorities. So for this purposes, they have excluded certain type of entities from the definition of PE, even if you have a fixed place of business. The condition is that you should only be doing preparatory or auxiliary activities. Now what it means is, if you are just using this fixed place of business for the display of goods, for the storing of goods, for the delivery of goods, or you are using this place to collate the information for your business purposes, it will not trigger a PE, even if you have a fixed place in the UAE. Now what's important is, it says it should be only for preparatory or auxiliary nature. Now what it means is, for example, for a manufacturing company, storing goods is an auxiliary activity. It's not their core activity. Core activity is to manufacture the goods and to supply the goods. But if we talk about Amazon or a logistics company, their whole business is built around storing the goods, displaying the goods and delivering on time. That's their main business. So in case of Amazon, the same activity could trigger a PE, but for a manufacturing company, doing the same activity would not trigger a PE. So again, this we need to see very much in detail. If you are fulfilling any exemptions, you are doing a preparatory or auxiliary activity. Next is Article 5 and 5.6 talks about the dependent agent PE or a DAPE, which we call it fondly. So dependent agent PE is a PE wherein you have a foreign company has an agent in the UAE who has the authority to habitually negotiate, conclude contracts on behalf of that foreign entity in the UAE. Now what it entails is that this agent, the company is operating in UAE through this agent. The contracts are directly signed by the foreign entity, but this agent is doing the bulk of the work to get the contracts, to negotiate, to get it to a conclusion stage. So whatever profits, this agent will be treated as a permanent establishment of the foreign company, and the foreign company has to allocate the profits to this PE and pay the due taxes in the UAE. Next, Model Tax Convention talks about a subsidiary. So they say that a subsidiary, if a head office is having a control over the subsidiary, does not automatically trigger a PE of a foreign head office in the UAE. However, there could be cases where a subsidiary is treated as a PE of a head office or a foreign company. For instances where the subsidiary provides a fixed place of business to the foreign company to do its business activities, or where it acts as a dependent agent of the foreign company. Now next, this is the case law which we were referring to, the way there was a Supreme Court judgment. So as a brief facts of the case, JP Group paid USD $40 million to the Formula One World Championship to host a F1 event in India. Now they paid this amount to get the right to host, stage and promote the Formula One event in India. Now the issue which was being debated or which was being argued at the court level or the ITAT level was that Formula One generated this income due to the access to a fixed place, which is the circuits or the racetracks in India. Would it trigger a permanent establishment of Formula One in the India or not? Supreme Court ascertained that okay, the length or the duration of the stay, that it's not important that you were here for, let's say, just a period of 60 days or 90 days. That's not relevant. The duration of stay is not relevant. What's relevant is, could you do that event without your expertise for this place? So therein the Supreme Court ruled that okay, since you have access, you had an access to these circuits, you had an access to the area where the event was being held, and that was a source of income. You have to generate, you are deemed to have a permanent establishment in the UAE, and you have to allocate part of your income to this P and pay the taxes, register in India and pay the income taxes in India. Next and the last, we discuss about the concept of source of income. Since the relevance of this concept is that if a free zone company has a source of income from UAE mainland, it could lose all its exemption on all its income. The other relevance is where the UAE entity needs to withhold the taxes of foreign companies, because withholding tax regime has also been introduced in UAE, albeit at the rate of 0%, but there has been a withholding tax regime. There has been an announcement of withholding tax regime. Now source versus residence is a very vast concept in general. We have just limited to these small points what PCT talks about. So PCT says that UAE sourced income includes, again the word is includes, it's not the exclusivity. It says any income earned from a UAE resident is a UAE sourced income. Any income which is, any payments which are attributable to a permanent establishment of a foreign company in UAE is a UAE sourced income. Any income which is derived from contracts or activities performed in UAE is again a UAE sourced income. So all these income which are sourced in UAE would be subject to taxes in the UAE. That's why the whole relevance comes in, especially for the free zone persons. They need to evaluate all their revenue streams to see what incomes could be construed as sourced in the UAE mainland, just not to lose the exemption of 0% or not to lose the 0 rating of the taxable income. So that's all from my side on the key concept for permanent establishment, place of effective control and management, residency and source of income. In case you have any queries, please feel free to ask. Thank you. Okay. They will be Q&A at the end.
Thank you, Prateek, for the insightful presentation. Now I would like to invite Mr. Krishnan and Mr. Suresh Panwar to give off a memento to Mr. Prateek.
Thank you for explaining the pure I know it was boring. Thank you. Very nice. Thank you.